Let me start with an uncomfortable truth. Most people don't fail at investing because they're unlucky. They fail because they never truly understand what investing actually is. They mistake motion for progress, excitement for intelligence, and hope for strategy, and the market has no mercy for confusion. I've watched people work for 40 years, good people, honest people. They saved diligently, avoided debt, followed every rule they were told would lead to security. And yet, when retirement arrived, they were anxious, uncertain, and disappointed, not because the system was secretly rigged against them, but because they were playing a game they never learned how to play. Investing isn't intuitive. Human instincts are built for survival, not for compounding wealth. What feels safe is often dangerous. What feels boring is often profitable. And what feels exciting is usually expensive. If investing feels stressful to you, if it feels like gambling, or if you secretly hope luck will carry you through, then this conversation is long overdue because money doesn't reward effort alone. It rewards understanding. Here's what I see over and over again. People buy stocks the way they buy lottery tickets. They hope, they pray, they check prices every day like a nervous habit they can't break. When prices rise, they feel smart. When prices fall, they feel sick. And when fear finally overwhelms them, they sell, usually at the worst possible moment. They chase what's hot. They copy what a friend bragged about at dinner. They read headlines instead of balance sheets. They confuse activity with progress. They confuse noise with information. And worst of all, they confuse investing with entertainment. The market doesn't care how hard you worked for your money. It doesn't care how badly you want success. It only responds to discipline, patience, and time. If you've ever felt that knot in your stomach when markets drop, you're not weak, you're human. If you've ever wondered whether you're already too late, you're not alone. If you've ever thought, maybe I'm just not cut out for this, then you're closer to the truth than you realize, because the real cost of getting investing wrong isn't just money. It's lost sleep, it's lost confidence, and eventually it's lost years you can never get back. Money mistakes compound just like money itself, only in the wrong direction. I've been investing for over 70 years. I've lived through crashes, bubbles, recessions, wars, inflation scares, and moments when everyone was convinced the world was ending. Every time the same story played out. People who panicked lost money. People who speculated disappeared. People who stayed disciplined quietly moved ahead. And here's what I learned the hard way. Investing is not about predicting the future. It's about behaving correctly over a very long time. You don't get rewarded for intelligence. You get rewarded for consistency. You don't win by making bold moves. You win by avoiding stupid ones. By the end of this conversation, you'll understand what investing actually is and what it is not, why most beginners lose money even when they're technically right, and how ordinary people build wealth quietly while others remain anxious forever. No hype, no jargon, no excitement, just how investing really works. Lesson 1: I stopped trying to be smart. When I was younger, I thought investing was about intelligence. I believed that if I read enough reports, ran enough numbers, and stayed informed enough, I could outthink the market. So I tried. I analyzed endlessly. I chased clever ideas. I believed complexity was a sign of sophistication. And for a while, it felt impressive. I sounded smart. I felt informed. I was busy. But I wasn't necessarily making better decisions. Over time, the market humbled me. It taught me something simple and uncomfortable. You don't need to be brilliant to succeed at investing, but you do need to avoid being foolish. Most investing mistakes don't come from ignorance. They come from ego, the belief that you're faster than everyone else, the belief that you've spotted something others missed, the belief that rules apply to everyone except you. The market has a very efficient way of punishing that attitude. The best investors I've known weren't geniuses. They were emotionally stable. They didn't need to be right all the time. They didn't try to impress anyone. They focused on decisions that worked, not decisions that sounded impressive. Complexity is often a disguise for uncertainty. Simplicity, when grounded in understanding, is strength. Stop trying to be clever. Focus on being consistent, patient, and disciplined. If an investment idea needs a long explanation to justify it, it's probably unnecessary. Lesson 2A: I treated stocks like businesses. One of the biggest mistakes beginners make is thinking of stocks as little pieces of paper that move up and down. That's a dangerous way to look at them, because if you see them that way, the market's daily noise becomes your reality. Prices fluctuate, headlines scream, and your emotions ride every wave. It's exhausting, and it leads to mistakes. I see stocks differently. I see them as ownership in real businesses. When I buy a stock, I'm not buying a ticker symbol. I'm buying a part of a company that makes something people want, employs people, and earns money. And if I'm wrong about the company itself, no amount of market speculation will save me. So before I invest, I ask a few simple, plain language questions. Would I be happy owning this company if the stock market closed for 10 years? Does it earn money in a way I understand without relying on fads or luck? Does it have a durable advantage that will protect it from competition over decades? If I wouldn't buy the entire business, I shouldn't buy the stock. It's that simple. Most beginners ignore this principle. They invest because a stock chart looks nice, or because the news outlet called it a hot pick, or because their neighbor bragged about it. They never stop to ask whether they'd feel comfortable owning the underlying business for the long term. That's why patience and understanding are critical. When you own a business rather than a stock, market swings don't matter nearly as much. You can ignore the noise, because what matters is whether the business grows, earns profits, and compounds value over time. Before you invest a single dollar, explain in plain language how the business makes money and why it will still be relevant years from now. If you can't explain it simply, don't buy it. Complexity is the enemy. Lesson 3, I learned that time is the real advantage. Everyone wants to know my secret. People ask, Warren, what stock should I buy next? What's your hot tip? How do I get rich fast? Here's the secret. It's not about the stock. It's about time. I started early. I stayed invested. I let compounding do the heavy lifting. That's it. Nothing glamorous, nothing clever. Most people underestimate how powerful time really is. They want results now. They panic when growth is slow. They sell the moment markets dip. And because of impatience, they miss the most important part, the magic of compounding. Compounding is not complicated. It's simply earning returns on returns. But it requires patience and consistency. A modest return over decades can grow enormous. Yet most people want to compress decades into months. I didn't get rich quickly. I got rich slowly, then suddenly. And it only worked because I didn't fight time. I let it work for me. Here's another reality most investors ignore. Even brilliant ideas fail if the timing isn't respected. A fantastic business bought at the wrong moment, then sold too soon, can destroy wealth. But a good business bought early and held patiently can multiply fortunes. The earlier you start and the longer you stay invested, the less brilliance you need. Time forgives small mistakes but punishes impatience severely. Start early. Stay invested. Ignore the market's daily drama. Lesson 4a. I did nothing more often than I did something. This surprises a lot of people. They assume that successful investors are constantly busy analyzing charts, reading news, jumping in and out of trades. But some of my best decisions were decisions not to act. I didn't trade frequently. I didn't react to headlines. I didn't panic during crashes. I learned that activity is often the enemy of returns. Doing nothing is hard. It feels uncomfortable. Your instincts tell you to act. It feels like you're not trying hard enough. But most of the time, reacting to fear or excitement leads to losses, not gains. Markets go down. That's normal. Fear goes up. That's dangerous. I've seen investors sell in panic and regret it for decades. The market doesn't punish calm, disciplined people. It punishes emotional ones. The key is emotional control, the ability to step back and let your strategy play out. Consider this: if a business you own is sound, if it earns steadily, if it has a durable advantage, do daily price movements matter? Not really. Yet most people let fear or excitement dictate their behavior, and that's where mistakes compound faster than returns. Doing nothing requires confidence. It requires trust in your analysis. It requires patience. And it requires humility, acknowledging that you don't have to act just because everyone else is panicking. If you feel the urge to act because you're scared or excited, pause. Fear is a signal about your emotions, not a signal about the market. The best action is no action at all. I want to highlight a subtle point most investors ignore. Psychology matters more than intelligence. You can understand finance perfectly and still lose money if you react emotionally. Markets are like a giant mirror. They reflect your emotions back at you. Greed gets rewarded with mistakes. Fear gets punished with losses. And people who master their behavior, not the market, end up ahead. Another thing, wealth is built quietly. Not with excitement, not with flashy moves, not with hot tips. It's built with repeated, disciplined decisions, with patience, with knowing when to hold, when to observe, and when to ignore the noise. You don't need to be a genius. You don't need to be fast. You need to be steady. Lesson 5: AI focused on not losing, not getting rich. This is where most beginners get it completely backward. They focus on how much they could make. They daydream about doubling, tripling, or even multiplying their money tenfold. They chase stories, tips, trends, and in a lifetime opportunities. They swing for the fences and inevitably they strike out. I focused on the opposite. I asked myself, how much could I lose if I'm wrong? Because if I avoid the big losses, the gains take care of themselves. Let me make this clear. You don't need to swing for the fences. You don't need to take unnecessary risks. You need to stay in the game. Wealth isn't about luck or luck's timing. It's about avoiding mistakes that compound faster than your profits. When you focus on not losing, you naturally develop discipline. You become selective about what you buy. You become patient about when to sell. You learn that the market will give you opportunities for decades. You don't need to catch them all. Every investment I've made had this filter. Will this ruin me if I'm wrong? If the answer threatened my future, I didn't buy. If the answer fit my risk tolerance and long-term strategy, I did. Simple as that. Before any investment, ask, what's the worst that could reasonably happen? If it threatens your financial future or peace of mind, walk away. Avoiding big losses is more important than chasing big wins. Protect yourself first. Profits follow naturally. Now, let's clear up a few myths that are misleading almost everyone who starts investing. This is wrong. Timing the market requires being right twice. When you get in and when you get out, most people fail at both. Markets are unpredictable in the short term. Trying to beat them day to day is like trying to predict the weather for the next 10 years. Possible in theory, impossible in practice. Instead, focus on being in the market for the long term. Let time and compounding do the work. The exact day you buy or sell matters far less than the duration you stay invested. You've been told to watch the market closely, to check prices, read news headlines, follow trends. In reality, the more attention you pay, the more emotional mistakes you make. Every tiny fluctuation becomes a reason to panic or celebrate. Your job isn't to react to every market movement. It's to stay disciplined and follow a simple, consistent strategy. This is one of the most dangerous misconceptions. Volatility, stocks moving up and down, is not the same as risk. Risk is permanent loss of capital. Confusing the two leads people to sell at the worst possible time. Short-term price swings aren't threats if you've chosen solid investments with long-term potential. True risk comes from buying something you don't understand or overpaying for it, not from temporary market noise. This is cultural conditioning. Movies, media, and social media make investing look like a thrill ride. In reality, excitement is the enemy of returns. Calm, boring, disciplined investing beats flashy speculation almost every time. After decades of experience, if I had to simplify investing into a framework anyone could remember, it would be this 4-step checklist. Know what you're buying. Can you explain how the business earns money in plain language? If not, don't buy it. Complexity is a red flag. Buy quality businesses or broad, diversified markets. Focus on companies or funds that can endure over decades. Avoid chasing fads or hype. Be patient. Let compounding work. Ignore daily market noise. Don't react to fear or greed. Time is your greatest ally. Abuse it and it punishes you. Respect it and it rewards you. Guard against unnecessary risks and emotional decisions. Avoid investments that could threaten your financial foundation. Avoid decisions driven by excitement or panic. Protecting your capital is as important, if not more important, than chasing returns. If you can do these 4 things consistently, you're already ahead of most people. Most beginners fail because they miss one of these steps, usually because they let emotions, excitement, or confusion interfere. Let me leave you with this final thought. Investing isn't supposed to be exciting. It's supposed to work. The people who win aren't louder, faster, or smarter. They're calmer, more disciplined, willing to look boring while wealth quietly grows over decades. If you're anxious about money, that's not failure. It's a signal to simplify, to slow down, to focus on what actually matters. You don't need to chase thrills to succeed. You need to avoid stupidity. I didn't build wealth by taking risks that excited me. I built it by avoiding mistakes, understanding the businesses I owned, staying patient, and letting time work its magic. Your journey doesn't have to be complicated. It doesn't require luck or genius. It requires understanding, patience, discipline, and humility. That's all. So if you want more hard lessons delivered without sugarcoating, hit subscribe. The next lesson will show you exactly what most people ignore and exactly what separates the anxious from the secure, the hopeful from the wealthy. Remember, investing isn't a sprint. It's a marathon run quietly, steadily, and without drama. And if you can master that, the rest will follow.